Geoffrey, good morning to you.
Morning.
What are the implications for energy and other commodity markets now, do you think, from what we've seen with this new sanctions regime?
Twofold. Firstly, it's just a matter of transactions and payments, how that's going to work out. I do think the entities involved will need to adjust, and we need to make sure that the financial plumbing in that respect is not impacted. But secondly, I think, and that's what markets are more focused on, is if there will be greater supply problems, then that's going to drive up prices undoubtedly. How will policymakers react? And here it really depends on how affected you are. In the US, for example, we don't see this changing the Fed's path at all, whereas in the EU and in the UK and elsewhere in Europe, you are looking at more stagflationary scenarios. Some central bankers may stress the need for more tightening, but others, and we're hearing this, say, from Poland and from the ECB already, previously assumed relatively hawkish or non-dovish rate paths. They may need to be reassessed.
So that's interesting. So you feel that monetary authorities will have to react to provide some cover for corporates, even as they battle inflation?
It really is a situation of where you need to target your approach. And right now, on the corporate side of things, how can central banks support them directly? That's really going to be tricky. I guess so there could be credit facilities and to make sure that liquidity is running. Again, going back to the financial plumbing, that is one area where central banks do have certain control over. But for the wider household, it really is a tricky situation because what was a stagflationary scenario that's been going on for about 6 months now, that is about to get worse. And that often is the toughest part for central banks. Do you target the price side of it, or do you target the growth side of it, because you really can't do both?
So what maths do you think investors should be doing as they look at their portfolios and decide whether they are positioned appropriately for the future?
In one word, margins. So identify the sectors where there is sufficient margin cover. And here you need to look at two things. One is the controllables. How much pricing power do you have on your product? So irrespective of where inflation is and irrespective of where the household is. So staples is an obvious example here. So that's on the price control. That's on the price transmission side. But also on the input side, where do your inputs come from? So for companies who have hedged their input costs or who can source their inputs domestically, they are more protected as well. So this is really a sector by sector and also company by company environment for equity investors. It's not going to be easy, and central banks will try to ameliorate the household, but the bottom line is where you can narrow the gap between your own PPI and your own CPI. That is where performance will be the best. And on a broad country basis, this again is one area where the US is perhaps better than Europe right now.
Given that you don't see the Fed changing, though, the rate hiking cycle at this point, does that leave you vulnerable if you've tried to find safety in the Treasury curve?
Yes, and I think markets will just need to adjust over the coming days or so. The Treasury curve, in terms of safety, I think the initial reaction is always going to be the case. When in doubt, flee to Treasuries. But at the same time, it's more about preserving liquidity at this point, because what we saw over the weekend in terms of what the market was worried about reacting to was a liquidity event as much as a safe haven event as well, or the potential for a liquidity event. And initially yesterday, when we looked at some parts of the market, such as FX OIS spreads, for example, there were signs of some liquidity stress. So when that comes, you actually want to be in dollar cash, or you just want to be in a liquid asset such as euro or sterling, for example. But now, once the dust settles, especially for areas and regions which are less impacted directly by what's going on in Europe right now, I think normal service will resume. And based on what the Fed's going to do, I think that the Treasury curve will react accordingly.